All right, my topic is mortgages and home equity lines of credit, otherwise known as HELOCs. So first, I want to define what is a mortgage. So in simple terms, a mortgage is a loan that an individual pays back when they purchase or refinance a residence. The lender, so a bank or a credit union, has the legal right to this property until that loan obligation has been repaid. And the borrower would then make monthly payments, including interest, to repay this debt. So what is a home equity line of credit? Before we answer this question, we would want to answer the question, what is equity? So equity is the difference between the value of a residence and the amount of liens or loan obligations against the residence. For example, if an individual has a $20,000 mortgage balance and the value of their home is $100,000, then they would have an 80% equity position in their home. Therefore, a home equity line of credit is a loan that allows a borrower to capitalize or maximize the equity they have in their home. A home equity loan can be a first or a second mortgage. So when an individual purchases a home, the loan is considered a first mortgage. If after, say, several years, that individual was to take out a home equity loan in addition to their first mortgage, the home equity loan would be considered a second mortgage. Or if an individual owns their home free and clear and they take out a home equity loan, that new home equity loan would be considered a first mortgage. Most lenders have restrictions that limit home equity loans to either 80% or 90% of the home's value. This lessens the amount of risk that the lender has in case the borrower were to default or not repay that loan. So types of mortgage loans. The first mortgage loan I'd like to talk about is the most common type of mortgage, which is a conventional loan. So a conventional loan is not guaranteed or insured by the federal government. Instead, the loan is backed by a private lender, such as a bank or a credit union. The next loan is an FHA loan. So this is a loan that's guaranteed by the Federal Housing Administration. And this means that when it's guaranteed, that means the FHA will buy back the debt if the borrower were to default on the loan. And it's intended for lower income borrowers, and it allows for lower down payments, sometimes zero down, and borrowers without great credit. And Lake Huron does not offer FHA loans. The next loan is a VA loan. This is guaranteed by the U.S. Department of Veterans Affairs, and it's designed for service members who do not have money for a down payment, and also maybe they don't have the best credit. And again, LHCU does not offer this type of loan. And next is USDA loans. They are guaranteed by the U.S. Department of Agriculture, and they offer zero down financing, and they also gear the buyers towards rural markets to stimulate the growth and the rural economy. And they're also called RD loans or rural development loans. So the first type of transaction for a mortgage that I'd like to talk about is a purchase transaction. So this occurs when an individual buys a primary residence, a secondary residence, or an investment property. So a primary residence is the home a person lives in during the majority of the year. A secondary residence is a home the person lives in for at least part of the year. So think vacation home, your cottage, or your cabin. An investment property. So an individual owns this property and another individual occupies the property. So think landlord and tenant. Down payment options. So there's many different levels of down payment. So the best option for a borrower would be obviously 0% down. So the mortgage program that offers 0% down would be a VA loan or a USDA loan. The next one, which is more common, is a 3% down payment. This is typically for first-time home buyers, and a first-time home buyer is considered a borrower who has not owned a property in the last 3 years. Next is 5% down. This is typically for a second-time home buyer. And then there's 10% down, which is for a secondary residence or vacation home. And then lastly, 15% down or more for an investment property. Down payment options. So for an LHCU fixed rate mortgage or a balloon mortgage, borrowers may be required to put down more than the typical 3 to 5% down, depending on the borrower's overall credit worthiness. Next, we can talk about refinances. So refinance, it's different from a purchase, and it occurs when an individual rewrites or changes their existing mortgage loan. And this can be for any number of reasons, including the need to take cash out. Maybe they want to improve their home or consolidate some of their debt, or maybe they want to get a better interest rate or a better payment. Types of refinances. So the first type of a refinance that we offer is what's called a rate term refinance. So the borrower refinances their mortgage in order to obtain a better rate, payment, or term, and sometimes it could be all three. The borrower does not receive any cash out from this refinance, and the only money added to their mortgage balance would be the closing costs that they could roll into their mortgage loan. Cash out refinance. So the borrower again refinances their home, but this time they're receiving cash out at closing. This cash could be used to consolidate debts. So maybe they're paying off a credit card or another type of loan, or they're using this money to make improvements to their home. Maybe they need, a common example is a new roof. So maybe they need to purchase a new roof for their home. A cash out refinance is similar to a home equity loan because the borrower is capitalizing on the equity that they have in their home. And cash out refinances are often riskier loans since money is being added to the loan balance. So most often the lender will have an LTV, so a loan to value restriction. They won't let the borrower borrow past 80% of the home's value. Mortgage products. The first product that we offer is a Fannie Mae loan. So this is FNMA, stands for the Federal National Mortgage Association, more commonly referred to as Fannie Mae. And their terms are 10, 15, 20, and 30 years. And they offer fixed rates, which means the rate does not change during the repayment period. And members make payments at Lake Huron, but payments are then sent to Fannie Mae. And how do I qualify for a Fannie Mae loan? So one of the most important factors is credit history. So to qualify for this type of loan, I'm going to need at least a 620 credit score. I'm going to need to have strong repayment history, little to no delinquency, and I want to have low credit card utilization. So I don't want to be maxing out my credit cards. Next important factor to qualify is going to be what's called debt to income ratio, otherwise known as DTI. So the maximum allowable DTI for a Fannie Mae mortgage is actually 50%. Typically, it's 43%, but actually under certain circumstances, you can qualify with 50% DTI. And you can see the little graphic here. It shows you what actually is DTI. So it's your debts, your car loans, student loans, credit card debt, divided by your gross monthly income. Next is your employment history or your income. So borrowers must provide at least 2 years worth of employment history. If they don't have 2 years of employment, they would need to have a valid reason as to why. And if the borrower is retired or receiving Social Security benefits or some other type of income, we would need to document this income. Next, which could be detrimental to the borrower qualifying for the loan, is something called a significant derogatory event. So if they have a bankruptcy or if they're foreclosure, the borrower may have to wait a certain number of years before they can qualify for a Fannie Mae loan. So if they have a Chapter 7, so as I was saying, if the borrower has a Chapter 7 bankruptcy, there's a 4-year waiting period from the date that either the bankruptcy has been discharged or dismissed. If they have a Chapter 13 bankruptcy, there's a 2-year minimum waiting period from the date that the Chapter 13 has been discharged. If they've had a foreclosure in the past, they have to wait a minimum of 7 years. And if they have any tax liens or judgment liens showing up on their credit report, those must be paid. Next, we're going to talk about private mortgage insurance. Borrowers who qualify for a Fannie Mae mortgage must pay private mortgage insurance or PMI if they're putting less than 20% down for their down payment. And PMI is a monthly premium added to the borrower's mortgage payment. And this is a type of insurance that protects the lender in case the borrower defaults or does not pay back the loan. And typically speaking, you're going to pay PMI for the first maybe 5 to 10 years of your loan or until you've paid down 20% of your original balance. So the Lake Huron mortgages, the first type of mortgage is a 5.5-year balloon mortgage, which is still amortized over 30 years, meaning you're still going to pay it back over 30 years. So what is a balloon mortgage? The interest rate may change once the 5.5-year term ends. And once this term ends, the entire principal balance is going to come due. And the loan is then refinanced, and your rate and your payment will then be determined by your credit score. And for this type of mortgage, PMI or private mortgage insurance is not required. Next type of product that we offer at Lake Huron in-house is a fixed rate mortgage. We only have 2 term options, so either a 10-year or a 15-year. And the down payment is either going to be 10% or 20%. And these can be used to purchase a home or to refinance an existing mortgage. And again, PMI is not required. Home equity loans. We offer 180-month or 15-year and 300-month or 25-year term options. And our home equity loans have something what's called a 10-year draw period. So that means that the borrower can draw out funds from their home equity loan during the first 10 years of their loan. So think of this as a credit card that's secured by your home. So as you make payments and pay down your credit card balances, you can again charge up those credit cards. So in the same regard, you can make payments towards your home equity loan, and once you accrue more equity, you can then withdraw funds as you see fit. And once this draw period ends, the borrower continues to make payments until the term is up. Home equity loans, they have variable interest rates. So the rates are dependent on the prime rate, which is determined by the federal government, and our rates are updated for the home equity loans every 6 months, every January and every July. And the maximum loan to value for a home equity loan is either 80% or 90%, depending on what the borrower qualifies for. And typically, closing costs are more affordable than a traditional purchase or refinance. LHCU mortgage and home equity qualifications. So qualifications, we discussed those for a Fannie Mae mortgage. It's fairly similar for a in-house mortgage or for a home equity loan, but certain exceptions are made to these qualification requirements and down payment requirements depending on the borrower's credit worthiness. So it is a case-by-case basis. And what do I need to qualify? So what do I need to bring to qualify for this loan, or any type of loan really? So you need either a purchase agreement or a mortgage statement. You would need recent pay stubs, 2 years of tax returns, 2 years of W-2s to show your income, proof of homeowner's insurance, or at least a quote, 2 months of bank statements, as well as a copy of your driver's license. There may be other documents that you would need, but this gets us off to a really good start. Closing costs. So what do I have to pay for before I can get this mortgage. So closing costs are the costs and fees associated with the mortgage process. So for a purchase, the seller can actually agree to pay for a certain percentage of the borrower's closing costs. This is called a seller credit or a seller concession, and typically this is 3%, and this can save the borrower thousands of dollars. Borrowers, to save money, can also receive a gift to help them finance closing costs. The borrower's relative would gift the borrower money with no expectation of repayment. And there's actually no limit to the amount of a gift that can be received, and you could receive a gift from multiple individuals if needed. For refinances, borrowers typically just roll in the closing costs. They have so much equity in their home that they can afford to add money to the loan and then not have to pay those closing costs out of pocket. And I just wanted to note also, closing costs and down payment, those are two different things. But your closing costs plus your down payment, that will equal your total cash to close, or the total amount of money you would need to bring to the closing. And then just some examples of closing costs. Your appraisal fee, that determines the value of the home. The title insurance, this ensures a clear title transfer from the seller to the buyer, and it also protects the investment in the property for both the borrower and the lender. And then there's also processing and underwriting fees. There are, a few other fees as well, but these are the main ones, I would say. And there are other loan costs associated with the mortgage process, being the first year of homeowners insurance. You're going to have to pay that up front. So that's typically, anywhere from maybe $700 to, in some cases, $2,000. So it is expensive for the first year of homeowners insurance. And then you're going to pay for your prepaid interest as well as your initial escrow deposit. And then I just kind of wanted to break down what is a mortgage payment. So what goes into a mortgage payment? Your P&I, which is your principal and interest. There's your homeowner's insurance. There's your summer and winter taxes. There's your flood insurance if necessary. So if the borrower lives in a flood zone, they would have to have flood insurance, and they would pay for that every month. And then also PMI if necessary. And then touching back on an escrow account. So what is an escrow account? It's used to deposit funds from your mortgage payment every month for your taxes, your insurances, and your private mortgage insurance as well. And it's deposited each time the borrower makes a full mortgage payment. And when taxes and insurance come due throughout the year, so every July and every December, the funds are withdrawn from this escrow account and the payments are made. And escrow accounts are required unless the borrower has 20% down or 20% equity. And then I just wanted to also touch on some of our current rates. So for a 5.5-year balloon, the rates are between 3.25% and 7.75%. For a fixed rate mortgage, you are at 3.25% to 8.25%, depending on your credit score, and you'd also need a minimum of 10 and up to 20% down. And then for our home equity loans, again, it's based on the prime rate plus either 1.5% all the way up to plus 2.25%, depending on the credit score. And then the Fannie Mae rates, these are updated as of last Monday. 10-year at 3.625, 15-year at 3.625, 20-year at 3.875, and the 30-year at 4.25. And then just one thing I wanted to note on the mortgage policy, the maximum amount of mortgage loans any one individual can have with Lake Huron cannot exceed $500,000. And lastly, how can members apply for the loan? They can apply in person, they can apply by phone, or online as well. Thank you.